Yes, a very good evening to all our guests right here. Welcome down to Geylang Serai's Virtual Community Club. How are all of you feeling today? And yes, today is actually Tuesday once again, where we are here to actually learn more about money mastery and of course how we are growing our wealth through our personal financial journey. So right here today itself, right, we actually have a topic which is actually called the what drive the foreign exchange market. So this is going to be a topic that we're talking about today in terms of Forex. So of course, the Money Mastery program right here aims to actually educate the public on the business and financial news. And of course, we are here to actually prepare our nation to grow further and of course, to be Asia's business and financial hub. So my name is Hui Jie and today I'm very happy to actually be sharing with you more items where we march on to a new topic of Forex itself. And right now, let's pan the screen on the slide. So to better outreach to the masses, it will be a series of dialogue with a twist of informal and interactive infotainment program covering local and international business news. And right now, we'd like to also share on the disclaimer itself. So this program is for information purpose only and should not be constructed as recommendation for purchase, sales, subscribe, or participate in any services or products. Before acting on the information provided, please consider if it suits your objective and risk tolerance. And of course, should you need professional advice, do consult the MAS Register of Representative List. If you need more assistance, what you can do is to, of course, refer qualified professionals for your consideration. So with that right here for today, joining me right here live in the studio is a special guest where he's actually the head of Asia Research from the ANZ, which is Australian and New Zealand Banking Group. And his past experience has been a lot in New Zealand, where he was the manager for something similar to like, Ministry of Finance right in New Zealand itself, the New Zealand Treasury, and also the economic advisor for the Reserve Bank of New Zealand. With that right now, let's join me and welcome Mr. Khoon Go.
Thank you very much, Ruji.
Thank you so much, Khoon. You sounded really, really international. Can you please share with us how did your career started in finance and stuff like that? Do you learn finance in school?
Sure. So I attended university in Auckland, in New Zealand, at the University of Auckland, where I majored in economics. That's where I really got interested in finance. So the only reason why I went into economics, actually initially I wanted to do engineering. But in high school, I studied economics for the first time, and I had a really, really good teacher, Mrs. Patel, that really piqued my interest. And as a result, I decided to shift into commerce, majored in economics, and managed to find a job. And eventually, as you saw, I managed to work in the New Zealand Treasury, which is the equivalent of the Ministry of Finance here, and also worked for a short while at the Reserve Bank of New Zealand, which is the equivalent of MAS here, before moving into the private sector with the bank, ANZ, and over here in Singapore as well, where I'm still with the ANZ after 15 years.
So ANZ actually sent you from New Zealand to Singapore, isn't it?
That's right. So I was very fortunate. I was working for ANZ covering the New Zealand economy, and then an opportunity came up to shift to Singapore, where ANZ was expanding very rapidly in the region at that time. So there was an opportunity to come to Singapore to basically do research on the macroeconomy in the region.
I have this question actually because to be frank, I studied economics as well. I didn't work for any banks and all that. But one thing I understand that back in my high school and all those kind of experience in Australia and all that, it's not that easy. It's not about discrimination or whichever. For someone that is non-local to enter into governmental company, isn't it? How do you make it there?
So I think in the case of New Zealand, because it's a pretty small country in terms of population size, I guess their civil service is not as choosy compared to, say, other countries. So they were quite welcoming. In fact, when I was working there in both the Treasury and the Reserve Bank, they would hire people from other nationalities, even though they were not citizens. They would welcome them as well. Yeah. Obviously, you have to go through the security clearance, just like everybody else. But they were quite open to talent, no matter where you were.
I'm pretty sure that you can actually share with us a lot of wide perspective in terms of international, forex and finances. Yeah. Okay, let's jump in for the topic for today. So before we actually kickstart, yeah. So for friends, please feel free to interact with us. If you have any questions and all that, feel free to just type it out into the chat box itself. If you have something that is more personal based, we know that this is finance. You don't want to share too much. Like example, I park into this forex. Is it a good move or whichever? This kind of item can be a little bit sensitive at times. If you'd like to keep it private, feel free to reach out to us via email, and we will attend to you in 3 working days' time. All right? Yeah. So meanwhile, at the same time, same thing as well. We're gonna be giving out prizes. Actually, last Sunday, we already chose 3 lucky winners. Later on, we will be outreaching to them to give them the prize of the $10 NTUC voucher. If you still want to win yourself with the NTUC voucher this time round, what you need to do is firstly to like and share this video, and next, what you need to do is to answer the question that Mr. Khoon, which is actually our guest right here, just going to throw to all of you. If you manage to answer it correctly, you might be one of the lucky winner that's walking away with this prize as well. So with that, let's kickstart the program proper for today. Khoon, please.
Thank you very much. Look, I think the foreign exchange market is actually very fascinating now. I think most people have experience personally, but most of the experience with forex maybe largely is exchanging money at a money changer when they go overseas on holiday. But actually, when you look at the foreign exchange market, it's actually the largest and most liquid financial market in the world. I think most people are more familiar with the equity market or real estate market or even the bond market. But the forex market is actually the largest and most liquid, far exceeding the equity or bond market. And trading is done 24 hours a day, 5 days a week. FX trading around the world actually starts in Wellington on Monday morning, and then progressively rolls throughout the world and ends on Friday at the New York close. The average daily trading volume in FX globally is 6.6 trillion US dollars. That's daily transaction. Hence, that's why it's a very, very liquid market. There are over 180 official currencies in the world. However, the predominant trade is actually done in the US dollar, where the US dollar accounts for almost 90% of all forex trades done. Now, we have to remember the other unique feature about the FX market is when you're transacting in FX, you are always buying one currency and selling another. Again, that's a major difference with other financial assets. Like equities, all you're doing is you're buying an equity, or maybe if you already have an equity holding, you're selling it. In forex markets, every time you do a transaction, you're always selling one currency and buying another. So there's always 2 sides to the trade. And the US dollar tends to be on 90% of one side of those trades globally. The other major currencies that tended to be transacted a lot is the euro, the yen, and the sterling, which accounts for around 60% on the other side. Now, the Singapore dollar is a freely floating exchange rate. It is transacted around the world, but the trading volume is actually quite low at only around 2% of global trading volumes. But having said that, Singapore is actually a major FX trading hub around the world. In fact, Singapore is now ranked the 3rd largest FX trading hub after London and New York. And Singapore, a few years ago, overtook Japan to be the largest trading hub in Asia and the 3rd largest in the world. And the Singapore, as a FX trading hub, continues to go from strength to strength, thanks to continued support from the government and MAS, where they're trying to make Singapore into a premier FX trading hub and able to attract talent and more banks and financial institutions to set up operations here. I think another important concept about an exchange rate is, once again, when you look at something like equities or bonds, you typically look at the price of that particular asset. Well, currencies is also something similar. You can think of a currency like a price. It's the price of an exchange rate. And currencies actually have a very, very important factor in that affects all our living standards, whether you actually realize it or not. So for example, in the case of Singapore, where we pretty much have to import a lot of the things that we need, for example, food or other items. Therefore, the kind of exchange rate that you have is very important in determining whether or not some of these goods is expensive or not. So indirectly, a currency affects a country's living standard. It's also an indicator of how well a country is doing. Typically, countries and economies that are performing very strongly tend to have a strong currency, whereas those that are poorly run tend to have currencies that are very weak. Now, currencies also affect competitiveness. Those of you that are in business, in the business of exporting, obviously will realize that you will tend to prefer a weaker currency so that you can export and get more in terms of foreign currency when it gets converted back. So exporters typically will prefer a weaker currency. But of course, if you're an importer, or if you are just a resident that wants to buy things from Amazon overseas in foreign currency, or pre-COVID when we could travel, you would prefer a stronger currency because it becomes cheaper for you to interact. So again, different segments of the population, depending on who you are, some would prefer a stronger currency, some would prefer a weaker currency. But I think there's one very important thing to bear in mind, in that you cannot depreciate your way to prosperity. Now, some countries typically prefer a weaker currency to help their export sector if they want to really build up their export sector. But over a long period of time, I think history has shown that no country can permanently depreciate your way to prosperity. What that means is you can keep your currency artificially weak for a period of time, but ultimately that doesn't tend to be a long-term successful strategy to move your economy up, because what tends to happen is that exporters become very conditioned to a cheap currency. There's no incentive for them to really innovate, move up the value-added chain, and at the same time, a weak currency actually makes imports more expensive. That actually lowers overall living standards. So again, I think while there's a temptation sometimes for a weaker currency, ultimately over the long term, a weak currency actually does not tend to help a country prosper. Now, when it comes to your own personal finances, taking into account how currencies move is actually very important. In the case, I give here a very, very simple example, a practical example. Now, I know a lot of Singaporeans like to invest overseas. And when you start investing overseas, it's actually important to take into account currency movements, because ultimately at some point in time, you will want to convert your overseas assets back into Singapore dollars, because this is where you need the money to spend. So I give a very simple example here of how currency movements over a long period of time can have a major effect on your investment returns. So here's an example here. Since 1st January 2010, if you were to invest an equal amount in SingDollar terms in both the Straits Times Index and the Malaysian equity market, as represented by the KLCI Index, since 1st January 2010 till now, your investment in the Straits Times Index would have gone up by 9.7%. Not too bad, but if you compare that to the KLCI Index, the KLCI Index over the same period of time has actually increased by 25%. So clearly the returns on the KLCI Index have far surpassed that of the Straits Times Index. But those returns are in local currency terms. Therefore, the KLCI Index returns are in ringgit terms. Now, if you were to bring your ringgit returns back into SingDollar terms, you can see how your positive returns in ringgit has suddenly turned into a loss in SingDollar terms. In fact, you are down about 2%. And that's because over this period of time, the ringgit has depreciated quite substantially versus the Singapore dollar. So again, this is why it's actually very important to understand and factor in foreign exchange movements, understand what drives it, because if you're undertaking investments overseas, that actually can have a material impact on the overall returns when it's translated back into Singapore dollar terms.
All right, so actually I do have this question, yeah. I recall a lot of times during I do some investment and stuff like that, right? I always have bankers asking me, hey ma'am, do you want to leverage on your program? Example, let's say I'm coming in to park in a certain fund to buy things like insurance products or even for like unit trust and all that. The bank will always offer me a chance to leverage, and they always tell me like, oh, actually our bankers will do their own spread kind of thing, where they will help you instead of borrowing from Singapore, you're borrowing from like Japan, and you use Japan yen to actually kind of pay back your interest. So through the return from the insurance, actually you cover back, and it's like zero cost for you. How does this entire thing work? I mean, why are we borrowing from Singapore, but it's actually through Japanese yen, and how does that actually help us to reduce our cost of borrowing?
So this is an area where, once again, you have to be quite careful and make sure you do your homework and analysis very well. So this is quite common in that in Singapore being a financial hub where we have access to all sorts of products, you are able to quite easily borrow in a different currency, in this case, in the Japanese yen. And part of the attractiveness of borrowing in a currency like yen is because the interest that you pay on a yen loan is a lot lower than in Singapore, and that's because in Japan they've had zero or negative interest rates for a long period of time. So it's much cheaper to borrow in Japanese yen because your interest cost is a lot lower. However, what you have to bear in mind is you are taking foreign currency risk because you are borrowing in yen, and ultimately you have to remember when it comes to paying back the loan, you have to pay the loan back in yen. So, under the best case scenario, the Singapore dollar appreciates, the Japanese yen weakens, you are able to then pay back your yen loan with less Sing dollar because the Sing dollar is appreciated. So that's the best case outcome. You not only save on paying lower interest, but you actually end up having to require less Sing dollar to basically meet your debt obligations in yen. That's the best case scenario. However, you have to take into account what will happen if the tables were to turn the other way. What will happen if the Sing dollar were to weaken and the Japanese yen were to appreciate, and perhaps quite substantially. In that situation, you might still save on the interest cost, but when it comes to paying back your original loan amount in yen, suddenly you might find that you actually need more Sing dollars to repay it. So this is where there can be a huge pitfall if the foreign exchange movements work against you. And there has been instances, and I'll just share with you that in the 1980s, in Australia and also in New Zealand during that period, when both countries first started to open up and liberalize their financial markets, a lot of farmers during that time, because both Australia and New Zealand have a big agricultural sector, the banks over there at that time actually encouraged people to take up loans in Swiss franc, because at that time the Swiss franc offered very low interest rates, far lower than in Australia or New Zealand at that time. So some farmers actually ended up borrowing in Swiss currency. But unfortunately for them, the Swiss currency started to appreciate and the Australian and New Zealand dollars started to depreciate very sharply. So a lot of these farmers actually ended up sitting on huge losses because when the Aussie dollar went down, suddenly when it comes to repay their Swiss currency loans, they actually needed, in some cases, maybe 10 to 20% more than what they had borrowed initially, and a lot of them got into distress. So So this is one of the pitfalls and the dangers when it comes to borrowing in a foreign currency that I think people need to be aware of.
Yeah, and especially if you're really looking into things like investing into, let's say, for an example, insurance, it might be like 10 years, 20 years kind of thing. And no one knows what will happen like after 10, 20 years, right? It's too far for us to predict, isn't it? So do you recommend us to borrow overseas for long-term type of investment, or something short-term is still fine?
So I think this is where, again, I'm not giving financial advice. Individual
Certainly.
circumstances have to be taken into account. But as a general rule, if, for example, the product that you're investing in generates income, maybe in a similar currency, so therefore you have a natural hedge, is what we call. So a natural hedge is when you borrow in a foreign currency, but you are able to generate returns in that currency as well. So at least you have some matching up in that sense. So under certain circumstances, I think that should be okay, because at least you are earning in that same currency. But if you are borrowing purely in a foreign currency just to take advantage of lower interest rates, but you're investing in something that, say, generates you income in SingDollars, then there's a mismatch. You're not hedged, so you're taking basically currency risk under that circumstance.
All right, that's a good advice actually, because a lot of people like us, like retail investors, who might not be aware of what's going on. Anyway, any reason why places like, example, Japan is giving out a lower interest rate in terms of borrowing, cost of borrowing? And I heard that in Japan, right, most of the companies, if you want to put money into the bank, or personal-wise, you want to put money into the bank actually doesn't give you any interest rate, or very minimum interest rate. And some countries, like even Denmark, they practice this thing called the negative interest rate, where once your amount hit a certain sum, they even will ask you to pay for putting money into it. It's like a security box. So what's happening in those countries? Why do they do it in this manner?
Yeah, that's correct. So what happens is, around the world, central banks set interest rates as part of their monetary policy. So central banks have the important role of setting the price of money, if you like, through interest rates. And typically, if a country is not doing well, central banks will tend to lower interest rates. Now, as a result of the global financial crisis in 2008, where a lot of the banking sector got into trouble, and a lot of economies went into deep recession, this forced central banks in some of these economies to cut rates to very, very low levels. And in some cases, and in the case of Japan, where they've basically been in recession or deflation for the last 3 decades, the central bank over there cut rates to zero, and they found that even at zero interest rates, it wasn't enough to really revive their economy. So they went further and went into negative interest rates. And some countries, like in Europe, Denmark, as you mentioned, their central banks have gone into negative interest rates to try and help to revive their economy. Now, because of that, that's why if you put money in a traditional bank in those countries, they're not going to pay you any interest, because they already have zero interest rates or negative. And the example you cite, in some cases, if you have a deposit that's too large, the banks will actually charge you money for putting money with them. That's because for the banks over there, where they have zero or negative interest rates, it actually costs them money to hold, to have your deposits. So in fact, they actually don't want your money, which is why they're trying to discourage you from putting money with them by charging you.
That's why there's so many Japanese investors that's flowing into Singapore. They are like, okay, once I hit a certain amount of money that I earn in the company, I just want to invest in a Singapore company. That actually helps us, isn't it?
So that's one of the features that is unique in Japan, for example, because they had such a long period where interest rates have been zero. And therefore, that forced a lot of Japanese investors to start to invest overseas rather than just putting money in Japan. So the Japanese investors are actually quite influential in investments overseas. Sometimes they can actually, believe it or not, move markets, given the size, particularly if they end up investing in the same product. Now, a lot of them try to look for what we call higher higher yields or taking part in what we call the carry trade. The carry trade is basically trying to invest in something that offers you higher returns, higher interest rates. So that's why they liked investing in Australia or New Zealand, because at that time it offered higher interest rates.
Yeah.
They like to, and they tend to be quite adventurous as well, the Japanese investors. They don't mind going into exotic emerging markets like Turkey, like Brazil, that offer, sometimes double-digit interest rates because it looks very enticing for them. But again, what I mentioned earlier, whether you're borrowing or investing in foreign currencies, you have to take into account what happens to interest rates, what happens to exchange rates, because you might earn double-digit interest rates, but if the currency moves against you, those returns can very easily just evaporate.
I think for people like them, might be slightly easier if they have businesses there and they can just like store it there for some time before they kind of change it back, right? And I think Singapore actually also have a very unique feature, isn't it? Let's take a look at a slide here. I think you also share with us this very interesting thing about the Singapore unique feature here. So what's happening in Singapore then in terms of foreign exchange and all that?
That's right. So as I mentioned earlier, a lot of countries, central banks, tend to control interest rates as a way to try and stimulate their economies. Now, Singapore is very, very unique. I think it's one of the very few countries in the world where the central bank actually manages monetary policy through the exchange rate rather than interest rates. So again, very, very unique. And the reason is that Singapore is a very small, open economy, very reliant on trade, and we pretty much have to import a lot of things. And as a result of that, the MAS believes that using the exchange rate and controlling it is more important and more effective in managing the Singapore economy and than setting interest rates. So this has been something that the MAS has been implementing for decades now, very, very successfully. And because the MAS controls the exchange rate, that means that they have to give something up. There's something in the international finance called the impossible trinity, where you cannot control interest rates and exchange rates and have an open financial market at the same time. You have to choose. And in Singapore's case, they decide to have an open financial capital system. They decide to control the exchange rate, which means they have to give up control of interest rates. So in the case of Singapore, our interest rates are actually heavily dictated by the interest rates in the US. So in fact, we import US interest rates because we are setting the exchange rate here.
So that means anything that's happening in US, Federal Reserve, whichever things that the president of US is talking about, it actually kind of affects Singapore's financial situation, isn't it?
Most definitely. Now, the US Federal Reserve is a very important institution. Now, what they do obviously affects financial markets all over the world. But in the Singapore context, because of our unique monetary policy feature, the movements in US interest rates almost translates through into Singapore interest rates. Not quite one for one, but to very, very closely.
Okay, and let's take a look at the next slide here. I think I see things like the Singapore dollars, nominal effect, exchange rate. Could you share with us more what's happening here? The chart seems going high. If I'm an investor, I'm really happy about it.
So this chart here is the Singapore nominal effective exchange rate, or the SingNER. So as I mentioned earlier, the MAS manages monetary policy through the exchange rate, and this is actually what they are trying to manage. So they don't manage the SingDollar as in the USD Sing rate. They actually manage it through what we call a basket of currencies. So that is a basket of SingDollar against currencies of Singapore's major trading partners. So it includes the US dollar, it includes the euro, yen, sterling, Aussie, yuan, ringgit, etc. Now, the important thing to note here is that what you will notice is over time, there is a tendency for the MAS to allow the Sing dollar to appreciate. So again, you recall what I mentioned right early on, where countries can't depreciate their way to prosperity. And I think this is something that Singapore government and MAS has taken to heart. they could easily engineer a weak currency to help exporters.
Yes.
But over the long term, that is not helpful for anyone. So instead, the policy here is to actually have a strong, stable, but strong Singapore dollar over time, because that actually helps to lift the country's living standards. But what it also means is for a lot of businesses, especially if you're in the export sector,
Yeah.
you have to recognize that over time, the Sing dollar will gradually continue to appreciate. So that actually means there's a huge onus on companies to make sure that they continue to innovate, continue to upskill their workforce, to make sure that they continue to move up the value-added chain, because if they don't do those things and the Sing dollar continues to appreciate, that's going to erode and eat into their margins and they won't become competitive anymore.
Yeah. I pretty believe there's a good reason why Singapore dollars is so strong, because it actually kind of help us reduce down the cost of import, right? Because Singapore basically has to import like almost everything. And at the same time, actually, it also helps us to boost better and to go into high ticket value item, right? I think just like you mentioned things like export, some of the things that is high value ticket will be things like, let's say, electronics, and we have like tech-related item, and we also have like medical, right? I think medical is something that Singapore is trying really hard to go into it. And I heard recently like Pfizer actually invested like about 100 million US dollars in Singapore. So why are all these things happening in Singapore instead of elsewhere? Is it because getting an injection and jab from Pfizer, Germany, and US, which is the two current plant that Pfizer is having, and right now in Singapore will give a better branding for the company itself?
So Singapore, some time ago, the government wanted to shift the focus on manufacturing and move up the value-added chain. And they started to try and encourage biopharmaceutical manufacturing in Singapore. So they were successful in attracting the big pharmaceutical companies to set up operations in Singapore. And that has been actually very, very successful. If you go down to Biopolis, for example, you will see a lot of these pharmaceutical companies setting up offices and production there. And that has actually been quite fortuitous, because pharmaceutical industry is obviously high margin, requires a lot of R&D, and because it's high margin, you also require a certain amount of high skill sets. You need, obviously, technology, and these are all the things that Singapore could offer those multinationals, which is why it was very attractive for them to set up here. And of course, with the COVID pandemic, and now suddenly, the strong demand for vaccines, that's why it places Singapore in actually quite a good position, because they already have this biopharmaceutical cluster here in operation, and therefore it makes it attractive for some of these multinational companies to choose Singapore to expand or put in place new facilities for these new vaccines.
Yeah, indeed. I do see a very, very good position for us to be a service-based country and a high-value ticket item country, right, for export purpose. And yes, we come to the quiz time right now. Okay, so this is actually the first quiz question for today. What does the MAS Singapore use to conduct monetary policy? Is it A, interest rate, B, credit rate growth, or C, exchange rate? Okay, so what you need to do before you actually answer the question, do like and share our video. And meanwhile, what you can do is to comment the answer. We understand that not everyone watched this live, so bear in mind that as long as 3 days within the date that we publish this video, which is today is Tuesday, if you answer it before Friday or by Friday itself, we will still count your position, okay, to win yourself a $10 NTUC voucher. All right, so what is next? Okay, we talk about Singapore dollars, and now it's US dollars, right? Because US dollars is kind of like affecting our Singapore dollars, and we kind of like benchmark it almost close to peg 1-to-1 with US dollars. So what is happening in the Federal Exchange and Federal Reserve then?
So the Federal Reserve is a very important institution. They set interest rates, obviously, for the US economy, but because the dollar is so predominant, what the Fed does affects the US dollar, and therefore by implication affects pretty much the exchange rates of every other country in the world, including in Singapore. Now, exchange rate is obviously one factor that affects currencies, but there are a few other things that tends to drive movements in exchange rates as well. So here I've listed a few of the key ones. How well an economy does obviously has an impact on the exchange rate, so rate of economic growth. Countries that tend to do very well tend to have a stronger currency, whereas those that are in recession or really struggling tend to have a weaker currency. Productivity growth is also a very important driver of exchange rates, particularly over the long term. Again, productivity growth is important because this is tied to moving up the value-added chain. If an economy is very productive, if your workforce continues to be upskilled and they're more productive, then that means that an economy can actually have a stronger currency on a sustainable basis. So the US during the 1990s tech boom was a period where we had very strong productivity growth in the US, and that resulted in a very strong dollar over that period. Inflation also is very, very important. Now, for countries that are not well managed and they get into a situation where they have very, very high inflation, or in some cases hyperinflation, that tends to destroy their currency. And we have many, many examples over time. I mean, Zimbabwe is a classic one, where due to economic mismanagement, they had hyperinflation, where inflation ran into basically the millions of percent. And as a result, their currency got devalued to the point where you could have, you can see there the image down there, $100 trillion note for the Zimbabwe currency. That's how bad things got over there. So controlling inflation is very important, which is why the MS here manages the exchange rate, but with a view of managing inflation within a low and comfortable range. And many central banks around the world are inflation targeting central banks. So that's why their mandate is to try and keep inflation low to preserve purchasing power of their currencies. Interest rates, I've already mentioned, very important, especially by the Fed. If the Fed were to hike interest rates, typically that tends to push the dollar stronger because suddenly you can earn more interest by parking your money in the US dollar. If the Fed increases interest rates, that tends to make the dollar more attractive. So more capital will flow towards the US dollar, making the US dollar stronger and other currencies weaker. And of course, political events. I think we've had so many over the last few years which have had a huge impact on exchange rates. I mean, Brexit was a clear one for the sterling. Right after the referendum results came out, given the uncertainty that they created, that sent the sterling tumbling. And we have had huge volatility in currency markets heading into the US election. The election of Trump in 2016 was a huge shock. That sent shockwaves around financial markets and caused a lot of volatility in FX. So these are some of the factors that influence exchange rates. This is not exhaustive, of course. There are many, many other things, but these are some of the key ones that tend to have visible impact on currency movements.
Okay, that's indeed something that I've pretty much learned. And how do we actually have a fair value estimate in that case? Like for here, we talk about like price of a Big Mac. Oh, I don't really like Big Mac. But anyway, so in New York, it is like same price, and in Singapore, it's the same price as well. So what does this actually share with us in terms of a fair value for currency?
Sure.
Yeah.
So, recall earlier I mentioned that, with currency markets, you can have a currency that's weak, but, you can't keep depreciating your way to prosperity. By the same token, you probably want a strong currency, but there's a danger if your currency is too strong, especially if your export sector is not competitive enough. That tends to erode your competitiveness. So therefore, that means that there must be a value of your currency where it is, fairly priced or fairly valued. So if you like, it's a little bit like, Goldilocks and the Three Bears. Is your currency too hot, too cold, or just right? So ultimately, what we want is a situation where currencies are fairly valued in that it's just right. It's not too weak and it's not too strong. But of course, the problem is, what is fair value? It's not something that is set in stone. It can change over time depending on how the economy evolves. So this example I've given here is just a very, very simplistic one. And this is known as the Big Mac Index. This was actually created by the Economist magazine, I think in the 1980s, as a very, very simple, cheeky way just to show whether currencies are expensive or cheap based on one single item. Now, of course, this is an oversimplification, but I think the underlying concept is quite sound. So why did they choose the Big Mac? It's because in the 1980s, and this was before Apple iPhone and all that, the Big Mac was probably the only one single item that is common, similar in product, and found in many places around the world. Thanks to the expansion of the McDonald's. So therefore, because it is a similar product, then looking at how much McDonald's charges for one Big Mac in different countries, you can work out the relative cost, of the exchange rate. So what is the fair value, if you like, and then compare that with the actual exchange rate at the time. And that's how you find out whether currency is over or undervalued. So in this example here, I just picked up the price of a Big Mac from the internet. So in New York City, as of the weekend, a Big Mac costs $6.19 US in New York City. In Singapore, you can get the Big Mac for $6.40. So the implied exchange rate based on the Big Mac index, which is just 640 Sing divided by 619 in New York, gives us an implied exchange rate of 1.0339. But the actual exchange rate, what you see on in the news and all that, is actually 1.3228. So that implies that the SingDollar is actually undervalued by almost 22%. Now, this is purely based on the Big Mac index. Now, of course, the reality is that we don't just base comparisons on one burger. There are many, many other things. Of course, there are local taxes, local other factors that are involved. But this is just a very, very simple illustration of how we can estimate whether currency is expensive or otherwise.
Yeah, so we kind of feel over here that the SingDollars is actually undervalued, right, by almost like 22%. So does that mean that it's better to eat it in Singapore then?
So again, this is just an example, and I think it's fair to say that most other estimates, more sophisticated estimates of fair value, do suggest that the SingDollar is still undervalued. Maybe not to the same extent, but at least it's showing you, it's pointing you in a similar direction that the SingDollar is still somewhat cheap.
So that's the reason why so many high net worth know that Singapore dollars is still undervalued. That's why they are like rushingly coming into Singapore to invest.
Well, I mean, there are other, of course, attractiveness of wanting to invest in Singapore as well.
Certainly.
The good workforce, modern infrastructure, rule of law, political stability, financial hub. Of course, if the currency is seen as undervalued and potential to strengthen further, that's yet again another positive factor for investors to want to move here.
And I think Singapore government is really doing a lot of things. Like I know that EDB, they actually have this thing called the GIP program, the Global Investor Program, where as long as anyone from overseas, you come into Singapore to invest like SGD 2.5 million into any company with the share, or start up a company with 2.5 million paid up capital and also hire local, you'll be almost like green lane to getting yourself an EP. There's really a lot of effort in Singapore, So let's take a look further out from the US side first, before we actually continue on to look into Singapore versus like US dollar kind of comparison. So what's happening in US dollar here is actually the world reserve currency. Do you think there's one day that SGD can be one? Or maybe you can share with us first on US dollar, how did it become the global reserve dollars?
So the US dollar at the moment is the preeminent global reserve currency. But the US dollar wasn't always the reserve currency. And what this slide here really is trying to emphasize is that over time, different countries and different currencies have taken the role as the reserve currency. If you go back far enough, you had during the Roman Empire, it was the Roman currency that was the was the reserve currency. You had the Dutch Guild, and you of course had the British pound when the British Empire was at its apex. The US dollar really only became the indisputable reserve currency pretty much after World War II. Now, one key feature that is immediately obvious when you look throughout history and which currencies have tended to be reserve currency is it tends to be the most powerful country or economy that have the reserve currency. And that's not by accident. And it doesn't necessarily have to be the most powerful economically, of course, that obviously helps, but also the most powerful militarily as well, which is why when the British Empire was at its apex and controlled many parts of the world, no surprise, the British pound was the reserve currency then. So right in this moment, the US economy obviously is the largest in the world. The US, of course, is the most advanced militarily as well. So therefore, I believe it's the dollar's role as the reserve currency is still undisputed. It will still remain the preeminent reserve currency for some time. Now, of course, history tells you that that doesn't always stay the way forever. At some point, there could be a challenger. So, this is the big question in FX markets. Who could be the next challenger, and when could be the timing of that?
I think I know. I think a lot of people has been debating about this, right? Will there be some, trades by Chinese yuan, okay? Because we all know that China is getting to become like the next empire of the whole world. And China government has been starting this campaign and so-called initiative called the One Belt, One Road. For those who are not familiar with the Belt Road initiative, it's actually called 一带一路, okay? Where they actually go to different countries in like Southeast Asia, even like Africa and all that. What they did is they actually strike deals with the locals, the tycoons, the conglomerate, or even for the government, to co-share the land together, help them build their infrastructure, give them, funding. They pay nothing. I mean, the local government pay nothing, while they actually get them to adopt Chinese yuan while they do trades and stuff like that. So will this actually be something that is happening, and will it really overtake one of these days? Yeah.
So remember what I mentioned. Typically, the reserve currency is held by the most economically powerful country. Now, at this stage, China is still at least a decade away, at least, from overtaking the US as the largest economy in the world. So based on current projections, if China can continue to grow at the way it has, then within 10, 15 years, China will most likely overtake the US to be the largest economy in the world. So obviously that will help fulfill one of the criteria, but that's not the only criteria. Militarily, will China, get to the same level or surpass the US? I think that's a little bit more debatable. However, even if China were to achieve those, we also need to look at, how comfortable and how widely used the yuan is at that time. Now, the US dollar, everyone knows it, everyone recognizes it, and when you hold dollars, you have a lot of options you can do with it. You can invest it in many, many things. You can buy many products. It's widely accepted everywhere that you go. But with the Chinese yuan at the moment, like if you have some yuan, like what can you actually do with it? Yeah, you can put it in a yuan deposit, but there's a certain limit to what you can do, and this is why China is trying to encourage more usage of the yuan, because in order to really promote the yuan to challenge the US as a reserve currency, you actually need more adoption, more people to be comfortable with using the yuan. So China is making steps towards that. So for example, now you mentioned the Belt and Road Initiative. That's one aspect of it. China now has allowed oil trading in yuan. Gold trading in yuan. They have opened up their financial markets. So now they are open and inviting foreign investors to invest in the onshore China equity and bond markets. So, if you compare now to 10 years ago, 10 years ago you couldn't really do much with yuan. At least now, if you had yuan, at least you can buy oil, you can buy gold, you can invest in the onshore China market. So there are more things that you can do with it. So it's heading in the right direction, but there's a lot more to go because like with the US dollars, you can actually invest in a lot of products created where you can invest in US dollars. With the yuan, it's still not quite there yet.
Yeah,
so I think China still has some way to go.
Yeah.
So this is why I think, at least for the next decade, I think the dollar is still safe as the preeminent reserve currency. I think after a decade, we'll have to see where the China economy is then, how much more open they are, and how yuan usage is at that time.
Yeah, and I think there's one thing called DCEP, the digital currency, the digital yuan itself, which is something everyone has been talking about in the global market as well, especially those who are in the fintech world, in the blockchain world. I'm pretty sure you heard about this term called the DCEP. So that is actually something quite innovative, yeah? And China is actually one of the first government in the whole world that's coming out with their own digital cryptocurrency, aka currency itself. So I think that might actually speed up for them to potentially kind of like overtake US in terms of...
That will definitely help, but China's definitely at the forefront in terms of the coming up with the central bank digital currency, but other central banks are also coming up with the digital currencies as well. Now, I think at the end of the day, the digital currency is still tied to the currency, and it's still backed by the state. So again, not to be confused with cryptocurrency, which is totally different, decentralized, not backed by any government. The digital currency is just simply electronic version of it, where it's easier to track, easier to transact, and ultimately you could bypass the current traditional banking sector in terms of transactions, so making it more seamless, cheaper, and easier to move money around.
Okay, all right. So I think we heard enough about US dollar and renminbi. I saw these things like US dollar look vulnerable. I do kind of agree because I know that US has been printing a lot of money. They are like trying to cover all their deficit and stuff like that. So why US dollar is going to this direction and why are they always on deficit?
So again, this is my view of where I see the direction of the US dollar headed. So with currency markets, obviously, currencies can go up and down. So this is currently, again, this is my view on the currency. Different people have different expectations of where the currency might go. My view is that I still see the dollar vulnerable to further weakness in the coming years. The reason is that, yes, the US economy is doing very well at the moment. There's no doubt about it. Yeah. But the US Federal Reserve is committed to keeping interest rates practically at zero for at least the next 2 years. They continue to print money. Therefore, they continue to, if you like, debase or erode the purchasing power of the dollar by printing more. I mean, if you think about it in simple terms, if you have too much of one thing, you basically erode the value of it. Yeah. So with the Fed continuing to print $120 billion every month, that has a corrosive effect on the dollar. But ultimately as well, the US government is running a record fiscal deficit. Now, part of the reason why the US economy is doing so well is because the US government has been giving out stimulus checks and spending huge amounts of money. And the fiscal deficit they are running has to be borrowed from overseas. And ultimately, this is what this chart here shows, in that ultimately the size of the US fiscal deficit coupled with its sizable current account deficit, over time that tends to be very negative for the dollar. So that's why my view is that the dollar will continue to weaken in the coming years because it will continually be dragged down by this record twin deficit that the US is running, and also the fact that the Fed remains committed to keeping rates very, very low for a long time, again eroding the appeal of holding dollars.
Okay, all right. So if the US currency continue dropping and stuff like that, right, will one day US go bankrupt? We know that, there are a few countries who defaulted IMF payment and almost went bankrupt, like Zimbabwe. I Argentina that is going on risk right now, Pakistan as well due to those floods and all the what they have like flies, grasshopper flying around and destroy all their crops and all that, and they even defaulted the IMF fund and all this. So what will happen to US? Will they like eventually go bankrupt if they print like that?
So this is one of the advantages of having a reserve currency, in that you play by your own rules. So the countries that you mentioned that have gotten into trouble, that have defaulted or required IMF assistance, those tend to be poorer emerging market countries, and so they don't have the luxury of being able to, if you like, print money to get by. The U.S., because they have the reserve currency, if they get into trouble, they can just print their way, which is basically what they've been doing since the global financial crisis in 2008. So the U.S. will never default because they can always just print more money. But of course, again, that's another reason why I think the value of the dollar will go down, because, ultimately foreign investors will feel that, if I want to continue to lend money to the U.S. government, I need some additional, incentive or compensation. So that can either come in a form of higher interest rates, but again, the Fed is not willing to do that because they want to keep interest rates low.
Yeah.
So if the U.S. cannot offer higher interest rates, then the only other way to entice foreign investors to invest is to have a discount, i.e. a cheaper currency.
Yep.
So that's why I believe that given what's happening in the U.S., a weaker currency is on its way, because that's probably the only way it can really attract enough inflows of money from outsiders to continue to fund their fiscal deficit.
So I think that's a hint for all of us, yeah. That means if US currency is going lower and lower, it also means that Singapore's interest rate is going to go lower and lower, isn't it?
And SingDollar will be stronger.
Yes, SingDollar will be stronger, but interest rate, if you put it in a bank and all that, will be lower. All right.
It will most likely remain low, yes, for some time.
If
the Fed continues to keep rates low, yes.
Precisely. So how do you think about Singapore then? I mean, we keep talking about SingDollars is very, very strong and all that. I understand that MAS actually has like 500 million with them. Temasek has like 300 billion, and GIC is unknown. So how do you value Singapore? Are we like a AAA country kind of thing? Or?
Yeah, so again, very different from the fiscal situation in the US. In Singapore, the country's overall financial situation is actually very, very strong. So Singapore is one of the few countries in the world that are rated AAA, which is the highest credit rate, sovereign credit rating, and Singapore's total reserves, which includes MAS, GIC, Temasek, is basically a state secret, so no one really knows how much it is, but it is a lot, and this is despite the government having to draw down on past reserves last year in order to fund the 5 budgets to fight the COVID. Despite drawing down the reserves, Singapore still has ample reserves. So the overall financial situation in Singapore is still very strong, very sound, which is again a factor that helps to underpin strength in the Singapore dollar.
Okay, I'm so confident right now with Singapore. We are like a AAA country that has a very, very strong financial, good management by government, and at the same time, we are attracting so many investors coming in, running to us, right? Okay, so right now, let's take a look at the next slide. Actually, we all talk about pandemic and stuff like that, and let's see what's happening in Singapore economy with this pandemic.
So this chart here shows the mobility in Singapore. Now, one of the aspects of the pandemic that hit last year is suddenly, everyone was trying to figure out the impact of it on their respective economies. Now, fortunately, Google, through tracking your devices, have come out with a real-time indicator of how much movement there is around shopping malls, supermarkets, residential estates, and also in workplaces. So this is one of the best real-time indicators we have about economic activity basically in the country. So this is mobility in Singapore, and you can see how mobility is affected based on restrictions that have been put in place. So during the circuit breaker, activity basically collapsed down to 60% below normal or baseline. And more recently, when we moved into the phase 2 heightened alert situation, you can see activity has suddenly fallen. Now, what we also know is that we are able to track also how quickly things will recover. So like right now, we know retail, everything is conditions will be very tough. But eventually, when the restrictions were to ease, and I think I'm heartened to hear what Prime Minister Lee said yesterday, and also the other ministers, where they indicated that it's very likely that there won't be any further restrictions, and that perhaps things can ease off from the middle of the month. Then we can track how quickly things will recover, and I'm confident we'll probably see a quick bounce back.
All right, so over here, actually, I see this slide where we talk about those that's hardest hit and those that's doing well. I saw things like manufacturing, ICT, financial, wholesale. So we all know that Singapore is an export hub, okay, so that's why wholesale makes sense. But manufacturing, do we mean like, okay, we as the locals in Singapore, we should look into the high ticket value item in terms of manufacturing, like example chips or I would say things like electronics, or if not, will be things like the medical items that you mentioned just now and biomedical and all that. Are those areas that we should look into more?
Yeah, so those are actually the areas that have done very, very well. So, yes, the pandemic last year has hit everybody, but in terms of the manufacturing sector, particularly the major export-oriented ones in Singapore, they've actually continued to do very well, and they've actually seen demand for their products rise last year, even though the pandemic hit. And that's because during the pandemic, if you think about it, where we went into circuit breaker, a lot of people were forced to work from home. That was the case all around the world, and all of a sudden, demand for things like laptops and just the basic technological gadgets that we need to function working from home spiked up. And I think that saw a huge boost to tech-related products, which Singapore does manufacture and export, so that helped. And of course, biopharmaceutical industry saw demand pick up, and again, that benefited Singapore very well. So that's why the manufacturing sector has actually done very well and continues to do very well. And that flows through into wholesale and financial services, ICT again, because it is an essential service, and as you mentioned, because Singapore remains very, very attractive as a financial hub. So that's why, despite the pandemic and tightening restrictions, those sectors actually have continued to expand despite the challenges.
I actually heard one thing. Last year, actually, there are few millions of dollars that flow in from the region's wealth. Is that true?
Yeah, so Singapore does attract, its fair share of wealth from around the region. And, that has been reflected in, rising foreign currency deposits, for example, rising assets under management by the various banks, etc. And of course, Singapore has recently been very successful also in attracting high net worth individuals to set up family offices in Singapore as well. So those definitely have been part of what has helped the financial services sector.
And some grants, like VCC grants, that's actually a collaboration between, I think, ACRA and MAS, right? They actually are pushing out really a lot of smaller funds. If you can't really set up a family office, you can do a VCC model in Singapore. I think that really, really helps us in Singapore, So financial services is the great trade, and we are all in a good trade. All right. And lastly, this part, actually, there's two more parts to go. Electric demand. I noticed that actually, there's actually quite a high demand that nowadays, even for all these items, we can search it on Google and we can understand fast, right? Okay, and we come towards the last two items. Here, global trade is actually rebounding strongly. So what do you think Singapore can benefit from global trade rebound? We noticed that last year everything is stopped. All the vessels are stopped, oil are stopped and all that, and now it's going high.
So look, this is very important for the Singapore economy because it's a very export-oriented economy. So how global trade does is very important because that will determine how well the Singapore economy will do. So this is again one of the key indicators I track, basically the number of container ships moving around the world. Last year during the pandemic, when most of the world was shut down, basically global trade came to a halt, so container ships were just sitting idle. But since then we have seen a very, very strong recovery in global trade. And this is a daily indicator, so this is again another real-time data that I track. It's telling us that global trade, despite the rising cases in parts of Asia, global trade is continuing to rebound very, very strongly. So that's why it gives me confidence that the outlook for the Singapore economy is still very, very positive for this year. Yes, we're going through a challenging period now with phase 2, where hospitality, retail activity will be impacted. But I think once we are past this period and once the restrictions start to ease again, I'm confident that we'll see a strong rebound because the global environment is very positive, particularly for Singapore's exports, and therefore the strong export conditions will very quickly start to spill over into the other sectors once the restrictions ease off. And I still expect the Singapore economy to grow very strongly this year, even despite the current hiccup we're in.
Yeah, so indeed we are very, very confident Singapore is going to do well for the next few months, okay? After phase 2, this tightened measure and all that, I'm pretty sure things will move fast. So do stay positive, and we are on the right track, okay? Especially in Singapore, we are safe, and of course we have to grow and strive further, okay? So with that, for today, we come to the end of the program. So right here we have the last quiz for today, which is quiz 2. According to the Big Mac Index, okay, which Singapore has a cheaper Big Mac, okay, so tell us, is the Singapore dollar either I'm pretty sure if you have watched it, you should know the answer, but not to worry, you don't have to answer it right now. If you do not know, please watch the replay. Someone asked me about the replay. I've commented back as well. With the link, you can always watch the replay anytime. Okay, so with that, if you have any questions, you would like to interact with us and talk to us and all that, feel free to reach out to us anytime. And once again, a disclaimer, this program is for information purpose only. All right, so last word of wisdom. What do you think about money mastery for our dear Singaporeans in terms of Forex?
Look, I think continue to educate yourselves. I think it's very important to increase your financial literacy. And, of course, it's always important to understand what's happening to equity, bond, real estate market, particularly in Singapore. But don't forget foreign exchange as well, because as I showed you earlier, especially if you're investing overseas, you need to know what's happening to FX movements, because that can have a huge impact on your overall returns at the end of the day.
All right, so now we are on this lockdown, so everyone can just kind of stay home, upgrade ourselves. We all know that we are on a high value ticket country, right? So we need to always upgrade ourselves, because we are definitely in finance, and of course definitely in a service-based country, that we need to actually provide value-added service to our neighboring country and the world, because Singapore is the financial and business hub. So with that, thank you so much, Khoon, for joining us. It's really, really delighted. Thank you so much. Okay, head of research right here with us, sharing with us so much of knowledge, and we are definitely very, very grateful for the sharing from you. Okay, so thank you. And once again, for friends, do join us again on Sunday. We will bring you more content and more valuable items to boost your personal finance journey. All right, thank you so much, and we would like to sign off right here. Thank you and good night.